What's up guys? Welcome back. Today we're gonna dive deep into the world of order blocks in the ICT concept. We'll explore what order blocks are, why they're important, and how you can identify them and trade them effectively. So let's get right into the video. So what are order blocks? Order blocks are areas on the chart where significant buying or selling activity has occurred. They play a crucial role in the ICT concepts because they can provide a valuable insight into the market sentiment and potential price movements. Understanding order blocks can help you make better trading decisions and improve your overall trading performance. So you need to know what are order blocks. And it's very simple. It's just the place where the smart money enters the market. So that's why it's important because, they enter the market somewhere. And if the price comes back into that place, they will make the same move again. And it's your second time where you can enter with the smart money into the trade. So it's very important. First time was when the order block was created. So let's get into identifying order blocks. Yo, leave the like. Don't be scared, just leave the like. Thank you. How to identify order blocks? It's very simple. So order block can be an opposing closing candle or candles before inefficient move happened. What is an inefficient move in the market? It's fair value gap or BC and CB. This right here would be inefficient move if it left fair value gap. And the candle before that was opposite closing. So if we are bearish and the last candle that was bullish is our order block. Now another thing, order block is the opposite closing candle of the move which took out the liquidity, or last candle that was opposite closing before liquidity was taken. So sometimes you will see some liquidity like equal highs or lows, and then you get a candle that's bullish like this, and another candle will be looking like this. It will be a bearish candle, but it took out the liquidity. But that's not our order block. Our order block is the opposite closing candle before that. Now, let me show you a couple examples because this is hard to show on the diagram, but it's very easy to see on the charts. This right here, in this place, is our order block. And why? First, we can see inefficient move. And before that, we can see opposite closing candles. We have bearish fair value gap and bullish candles before that. And if you have more than one candle, take all of them and mark out their bodies. And that's your order block. Very simple. And now, how to know if your order block has higher probability? It's basically the more the order block does, the higher probability it has. So we can see this order block took out this liquidity right here on the 5-minute chart. So we can see 3 equal lows were taken out, and then we have inefficient move to the downside. So this order block is very strong, and it would be your entry point. Now let's look at the second example where the order block is before the liquidity was taken. So for example, right here. Okay. We can see that there is this low, which would be our liquidity. Then this next candle touched the low, which you should look at other charts too, like NQ, and just see if they took out the liquidity. If they did, just touching the point is enough for the liquidity to be basically taken. So we have this candle right here that's bullish, but our last bearish candle is our order block. So this would be our order block. You want to wait for the price to move outside of this block. On this candle, we moved outside, we closed above, and now you want to see this order block to support the price. And that's exactly what happened here. So this would be your entry point. Let's look at how you should trade order blocks. It's very simple. So we identified this order block right here. Your point of interest on this order block would be the low. So if you are going short, the low would be your first entry, which would be the worst entry, but also highest probability to get entered in the trade. Then your second should be in the 50%. And last should be at the top or bottom of the order block. But this order block is a little bit different because you only mark out the bodies. If you have order block like this one or this one down below, if it's just one candle, you should mark out the wick and the body, but not the opposite wick. And if this is your order block, your entry should be on longs at the top, then at the close of the wick basically, and then 50% of the candle, like this. You don't want to see the price to go lower really, but remember, candles tell the story, wicks do the damage. And what that means is you can see this candle right here have a wick like this. And if you had very small stop loss, it would take you out. But the trade idea would be still right. And you would lose money for no reason. So set your stop loss in some good place where you will not be just taken out because you were too scared to lose money basically. Now, let me show you some trade examples to show how this looks like in live action. So let's look right here. We can see that this down closing candle took out all of the liquidity. So right now, this is your order block. You can enter long here. Your stop loss should be below this wick at least. Now we can also see that first, this order block took out the liquidity, and also we can see inefficiency right after. So let's see what the price does now. And now, again, these two candles will be also your order block with the wick. And what happened? We have inefficiency in the market. We have candle that closed above our order block. And then you could enter on this candle again. And once again, this would be also your small order block. And now remember, the smaller the candle is, the less of a probability there is of the trade to work out how you want it. Or basically the order block is not as efficient. So look for bigger candles. But don't forget about the small ones, you know. Okay, another order block right here. So take out the wick and the body, extend it out. Now, I don't know what's before the chart, but somewhere would be your take profit. I'm not sure now, but this is just to show you an example how this looks like in real action. So this is your order block. So if you would want to enter again, for example, if you were too slow to enter on a trade here or here, this would be your second or third time you could enter again if you were bullish and believing it's gonna go up and up. So let's see if you get another chance. Now, another one. You can enter again here. So once again long. We want to see it hold. And look, your order block can fail if you have more of them on your chart. So we can see this one fail and this one hold. But if this one fails, you shouldn't be in the trade anymore. Because if 3 of your PD arrays fail, that's a sign that your idea is wrong. So that means if fair value gap fails, if your 2 order blocks fail, well, that's 3 PD arrays, get out of the trade. So let's see how this plays out. If we get, okay, another entry here. And the price continues. There is another order block. But you see, it's very simple. So if you guys like this video, please leave a like and subscribe.